Hello, I'm Deborah Trow, the founder of Elevation Wealth Partners, and this is the Elevation Market Update. I'm in conversation today with Noel Doiron of T. Rowe Price. Noel is a vice president and regional investment consultant with that firm. She's been with them since 2018, but has over 16 years in the business. So Noel, welcome back.
Thank you, Deborah. Thank you for having me back. Happy to be here.
And I am really glad to be talking with you this morning. There's a lot going on in the world, of course, that we want to get into. But first of all, I'd like to kind of wind things back a little bit to the beginning of the year and just talk about those first 2 months and what T. Rowe was thinking for their outlook in that part of the year.
Absolutely. Yeah, a lot has happened. We can pretty much say that every call since the start of the year. But if we kind of dial it back to, the end of 2025 and looking forward to 2026, some of the things that we were really optimistic about at T. Rowe Price continued to be some of the areas of the market that were beginning to work really well last year too. So international equities, even emerging markets, and then small and mid cap companies. Just that idea of broadening away from the 5 to 8 companies that seemed to really control market returns over the past few years. We started to see the market broaden out into those areas of the markets, and we remained and continue actually to remain optimistic about those areas over the more intermediate term.
Well, optimism is always good to hear. But let's talk about end of February, US started action in Iran, which is continuing today with this fragile ceasefire that we have just for the moment. So how has that changed things?
Yeah, it's definitely caused some friction in the market where the areas that we were most optimistic about, international equities and small and mid cap companies, did end up, selling off or declining the most during this period. In our view, we expect that, as you mentioned, the fragile ceasefire, as we continue these talks and negotiations and discussions, that there will be, down days, really positive days in the market. And we expect that international and small caps during those down days will continue to be down. And during those really good days will be up the most. We saw that, as recent as, the past few days with international equities and small and mid caps. So we do expect volatility in the near term, but I would say that our kind of intermediate, longer term projections have not changed aside from one area, and that is inflation. It's a scary word because we all remember 2022. As of now, we don't expect inflation to go up to, 8, 9% like we saw then. But it is the area in the market that I would say we are the most concerned about, and the area of the market that we don't think is, properly being priced in or properly being taken into account. So at T. Rowe Price, that's really where we've made some adjustments in portfolios, is trying to hedge against some of that inflationary impact.
And when we're talking about the Middle East, we're always going to be talking about oil, right? Major production area, and an area also that a lot of transportation through back and forth. So I know you don't have the crystal ball, but what might the impact be as far as that goes?
Yeah, I think people here in the U.S., if you've been living here for quite some time, you get a little concerned about impacts to, oil shortages or oil blockages, or the friction that we see now with the Strait of Hormuz. Because if you go back to the 1970s, you remember waiting in line and gas stations and being short supply. What I do, before I kind of get into a little bit more, what I do want to remind people here in the US is that we've really changed how we essentially operate from an oil standpoint or an oil supply standpoint. We used to be importers of oil, and that was the case in the 70s. And we really learned our lesson that we have this natural resource here in the US, and you've seen us really increase our supply where I think now we're producing, 13 billion barrels a day plus. Like it's a lot of oil that we're producing here. So the good news for us here in the US is that we shouldn't have to worry about supply shortages like we did in the 70s. However, we are, as we are all experiencing today. I just filled up my tank yesterday and was appalled. But we are going to have to deal with price increases at the pump. Um, there that is different than other countries. We're now an oil exporter versus an importer. There are other countries, particularly Asian countries, European countries, who are oil importers. So we are seeing countries in Asia who are basically having work from home mandates because they need to preserve some of their oil gas supply because there is a chance that there could be a shortage for them. So, from a day to day standpoint, aside from prices, it's not something that fortunately we have to worry about. The one area, and this gets back to my comments about inflation, that will probably impact us a little bit more is what's going on in the fertilizer market, which isn't talked about as much yet, but could be an issue if we see the strait closed for an extended period of time. There's a lot of fertilizer that goes through that strait that our farmers here in the US depend on. So spring is coming up, or spring is here for some places, right? And it's a really important crop season. And so our farmers need that. Farmers around the world need that. And that's where we see the impact of inflation that's not being taken into account with food price inflation, which is the last thing people want to hear about with grocery prices higher than they are. But I would say overall, that is probably the main impact that we will probably feel day to day in the coming months.
Yeah, as you said, we already are paying a lot for food, not looking for any further increases there. But yes, the cost of moving that around and growing the food, it all will have an impact. And I'm glad you talked about the lines at the petrol pump, at the gas pump. You can hear I'm English here. Uh, that a lot of people do remember that. I'm having a lot of conversations with people, so I know that brings it right back, kind of to the heart of something that was difficult. And of course, people in other countries, as you say, they're really feeling an immediate impact already, but we are not. So let's talk, when we talk about inflation, I think we're always going to be talking about the Federal Reserve. The last meeting they had, they kept rates steady. So what might be happening the rest of the year now?
Yeah, there's some interesting things going on in the Federal Reserve. You Many of you who are watching this probably know that Jerome Powell, the Fed chair, is likely to be replaced by Kevin Warsh in the coming months. Um, Kevin Warsh is someone that the Trump administration is nominating because he's kind of on their side, and they clearly want interest rates to be cut. So prior to Iran, the conflict in Iran, our view was in the second half of the year, we might get 2 or 3 interest rate cuts, right? Because that was kind of the bias of the incoming Federal Reserve chair. Now, there's a few things that I want people to understand about what's going on today and just the makeup of the Federal Reserve. Um, Jerome Powell today, Kevin Warsh in a few months, they are not, the people who make the ultimate decision. They're chairmen, they are spokespeople. There are a dozen voting members on the Federal Reserve Board. So, in order to cut interest rates, Kevin Warsh really has to convince these voting members that that is the right course of action. Our belief is that Jerome Powell probably stays on the Federal Reserve as a voting member. And today, because he's been there for so long, he has more confidence and persuasion power from the Federal Reserve voting members. So our view is, he probably still is the dominant member in the Federal Reserve, helping guide their decisions. And when you factor in what we have today with inflation, in our view, that is likely to go up, not dramatically, hopefully, like we saw in 2022, right? But if you have inflation that's likely to go up, that's 1 point against, the drive to cut interest rates, because we don't want to cut interest rates as inflation is going up, because that will send inflation further up. um, the other thing that we have, and this is the positive note, is it doesn't always feel like it. I mean, just today, as we're recording this, we got a really horrible consumer sentiment number. So consumer sentiment, we all feel it. We're concerned, we're anxious, we're worried about what's going on. But the fact of the matter is that economic growth is really strong. We've got these mega tech AI companies that are spending trillions of dollars into our economy today to grow our economy. We've got an employment market that is not falling apart like we were concerned it was going to be falling apart earlier this year. And our economy is just it's on good footing. And one of the things that we point out oftentimes, this is an index that a lot of I don't think folks who aren't in this industry don't follow, but there's something called the economic surprise index. And so basically there's consensus estimates for all these different numbers and readings and data points. And the economic surprise index basically calculates, okay, how many of these are surprises to the upside, like really good positive surprises versus surprises to the downside. And we still continue to see many more surprises to the upside on these data points than we do to the downside. So overall, our economy, although it feels like we're on shaky ground, overall, our economy is on pretty solid ground here. So good growth, pretty solid labor market. That's another knock against the Federal Reserve being able to cut interest rates. So now our view, once you have Iran, Jerome Powell staying on board, pretty solid economic growth, all of that factored in, now our view is we may not get an interest rate cut this year. Maybe one, but we're going to have to see inflation kind of fall back in line before we think we can even get one interest rate cut.
Yeah, it doesn't make sense for sure. And the Fed probably has the most challenging job there to carefully get us through this balance between employment and inflation. Um,
Exactly.
yeah. So a lot of talk about what's going on here. But of course, in our world, what we're looking for is, well, what's the impact for an investor? Um, Putting our money into companies and having it grow for the future. So I know that there is always opportunity to invest, even when things are rocky, sometimes even more opportunity that might be expected. So tell us a little bit about what T. Rowe is seeing there.
Sure. I would reiterate the international equity and small and mid cap ideas and stories. Again, those are areas that will be hit hardest on the most difficult days in the markets. But those are the areas that will rebound on good days and kind of as we're getting through and on the other side of this conflict. I think the excuse me, the other area which we've all talked about a lot and we've all heard a lot about is artificial intelligence. And, we continue to believe that those big, tech companies, your Meta, your Broadcom, your Nvidia, those are going to continue to gather share. But now what we're seeing, going back to something I said earlier, is this idea of broadening out. So in order, for example, to run these data centers, we need help from energy companies, utility companies. So, some of our top managers at T. Rowe Price, looking at names like Constellation Energy, Centerpoint Energy, NiSource, all of these are, Constellation does nuclear, NiSource natural gas. Centerpoint was when I lived in Minnesota, they were my utilities company. So these are companies that can help in that artificial intelligence build out. And that's kind of where we're looking now is, where are the next winners going to be in this artificial intelligence build out over the next, not just 2 years, but 5 to 10 years. And by the way, if you've looked at markets or your portfolios this year, which has, I'm sure, not been the easiest thing to do, but you probably have noticed that your growth companies, your technology companies, artificial intelligence like companies have sold off more. So now is maybe the time to be investing more in them as they're down and they're priced, maybe more, I don't know, more appropriately or more comfortably for when you're ready to get in.
Yeah, using that principle of rebalancing always that allows that to happen naturally, right?
Yes.
Without having to stock pick. So, how does an investor stay positive in a challenging year like this?
I think there's a couple things to think about. First and foremost, most calendar years do have a correction in the stock market, and a correction is defined as down 10% from peak to trough. So that is very typical in a market. What is not typical, but what happens during a business cycle is the scary R word recession. For us, that's off the table right now. So that's not even something I've heard anyone at T. Rowe Price talk about. So keep that in mind. Again, our economy is very strong. We're in the middle of a war, a conflict, a geopolitical event with Iran. And what we have seen over the past 64 years, there's been a total of about 14 major geopolitical events. If you look at those different events and you average out the next 12-month or 1 year return on the S&P, you get to about 9.5% return, which is pretty solid for, still kind of muddling along through a geopolitical conflict. So keep that in mind, because that is what is, causing us a lot of anxiety now, is this conflict. And then the last thing that I point to, which we've all been living over the past few years, and I'm going to consult my notes because there's a lot here. So since early 2022, we've had multiple things that have happened in our world. We have had a conflict between Russia and Ukraine. We have endured, as I mentioned before, 9% inflation. We have had 5.5% interest rate or Federal Reserve hikes to contain that inflation. We have had regional banks that have failed. We have had tariffs across the world, and in spite of all of that, the S&P has still gained over 50% since 2022. So even though things can feel really difficult and chaotic, the markets can still move higher, and it's because our economy here is still very strong.
And as usual, it's making the case for staying the course, keeping with the plan. And Noel, I love that you're bringing all these hard data points because the numbers tell the story, right? They tell us what has happened. And that's something to hold on to keep in mind as we have all of this noise going on currently. So we're only at the first quarter of the year gone by. We have a lot to go yet, and it will be interesting to see how things unfold for us as investors. So stay tuned. Our next market update will be in May or June. And Noel, thanks so much for joining me today.
Thank you, Deborah. It was great to be with you.